I'd like to welcome everybody to our webinar today. The webinar is Knowing Your Financial Institutions. I am Brandy Reynolds, the Managing Director at Bates, our moderator, as well as our panelist. But first, I would like to have just a special thank you to the MSBA for co-sponsoring this webinar and for those members who were able to attend today. So thank you very much for your support. So first we have John Ashley. John is a Bates Group managing consultant with 10 years of financial crimes and regulatory compliance experience in payments, remittances, banking, and cryptocurrency. At Bates Group, John leads the FinTech and Banking Practices Compliance Support Team, which assists traditional and cutting-edge FinTech clients in navigating unique compliance challenges, including compliance program development, remediation, and look-back efforts, systems implementation, and compliance operations. John has consulted for a variety of firms, including large regional banks, industry-leading payment processors, international remittance providers, and cryptocurrency development foundations and exchanges. He also specializes in U.S. data privacy compliance and holds a CIPP US certification from the International Association of Data Privacy Professionals. Lauren Benjamin is currently the Deputy CCO, BSA officer for Kraken's U.S. operating entity. In her over 5 years at Kraken, she has served as CDD Senior Manager and began her career in crypto in the Enhanced Due Diligence team at Kraken. Before joining the Payward Group in 2019, Ms. Benjamin was a compliance officer, AVP, with Global Group at Bank of the West, where she focused on program and policy development and management, risk assessments, and compliance governance controls. Throughout her career in global financial crime compliance, Ms. Benjamin also served as senior investigator with the financial investigative units at Bank of the West and Union Bank. Ms. Benjamin is a certified anti-money laundering specialist with ACAMS, CACS certified, and holds a chain analysis reactor certification. Nyla Dolatova is a seasoned executive compliance officer with over 16 years of experience in the financial services industry. She has held key leadership roles, including Vice President at Appfolio and Head of Compliance Americas at Currency Cloud. Nyla is a recognized expert in BSA AML requirements. Throughout her career, she has successfully built teams, developed and implemented robust compliance programs, and managed complex with CFPB and the payments, crypto, and cannabis. Currently, she serves as Senior Director for KYC and Sales Compliance at Circle, working closely with different members of the compliance and business teams to establish global policies and frameworks. As part of her experience, she has overseen and provided guidance on compliance programs. We welcome everyone to the webinar today, and I'd like to hand it off now to John Ashley, the moderator.
All right, thank you very much, Brandy. Welcome everyone to our webinar on knowing your customer. Before we jump in today, a couple of housekeeping notes. First off, by all means, if you have questions during the webinar, please use the Zoom Q&A function to raise them. We will address them as time permits at the end of the webinar. Additionally, after the webinar has concluded, we will provide a copy of the slide deck as well as a link to the recording to all attendees. And with that, let's dig in. So, KYC, knowing your customer, knowing your business, depending on how your firm is oriented, it can mean both of these things or one or the other. And it's one of those areas of compliance that is simultaneously one of the hardest to implement from a control framework standpoint internally, and also the one that really most impacts your customers and their experience with your business. We all know it. We may or may not like it, but we all have to do it. There are legal requirements in the US for this, as well as in pretty much every jurisdiction in the world that has adopted a comprehensive anti-money laundering framework in legislation or regulation. You know, in the US, we have our favorites, such as the Bank Secrecy Act, Patriot Act, the Anti-Money Laundering Act, not to mention numerous state requirements, as well as the plain fact that KYC is a good control to have. You need to know your customers because this prevents your platform from being exploited by bad actors, and we'll dig into that a lot later. On the flip side, though, KYC presents a resource burden and a potential for a lot of friction when it comes to your business. There are impacts to your customer journey. There are challenges of dealing with a large amount of information that has to get processed, analyzed, screened, and so on. And as we'll dig into, particularly in this section, there are unique challenges posed to businesses when it comes to onboarding virtually as opposed to the more traditional in-person form. The legacy idea of verification is an experience that I think most people on the panel and in the audience have had in their lives. Going in to open a bank account, you have to be physically present. You have to physically present 2 forms of identification to a front office, first line of defense person. And this presents a lot of risk. There is high potential for fraud there. There's high potential for me to simply, lie in the case if I'm a bad actor trying to get past the KYC process. And there's not a whole lot of information that you get from that physical face-to-face interaction. Nowadays, especially in the last 10 years or so, we've sort of pivoted. We have software now that can analyze documents, that can streamline the virtual account opening process, that can look at, my activity with regards to the platform, how I interact with it, how I log in, how I manage my account, to develop an alternative profile of who I am. However, this also comes with challenges. For one thing, we're looking at a regulatory environment, at least in the US, which is still fundamentally, based on the idea that you are really communicating with a physical person in a physical face-to-face interaction. And at the same time, there are so many tools out there that allow us to, better understand our customers, better analyze their behavior, and better fine-tune these approaches. So we're in a little bit of a bind right now from a professional standpoint. On the one hand, we're trying to comply with regulations, and we want to know our customers. We want to know who they are, what they intend to do on our platform. We have all these amazing new tools, but we're also working, with regulations that are in many ways behind the times. So to kick off our panel discussion here, Lauren, I'd like to start with you. When it comes to, this sort of difference between the regulatory expectation that's based on these physical interactions versus customer bases that are predominantly virtual and tools that are predominantly virtual, what difficulties have you experienced fine-tuning your tools that you use, software, virtual verification, analytics, and so on, to adapt to both a regulatory requirement that is somewhat out of date, but also expectations from your customer base, as well as, your business, that things move virtually?
I think some of the greatest difficulties we face in terms of identification of our documents and identification of the client itself is that as a global operating entity, the coverage and the scope of coverage, the breadth of coverage that your vendors have is truly key. I think that when you find, for example, the United States has a fairly consistent verification rate, sometimes between 75 and 85% in terms of passing rates for our clients. However, other jurisdictions can fall well below that, at 50 or lower percentage. So when you're looking at utilizing vendors, tools, software, and things of that sort, you need to identify those that have a wider scope of coverage, that either have specialities in the certain areas that you're trying to target it, and then implementing multiple vendors in order to have a waterfall effect, so that if you don't have the ability to verify with one particular vendor, you do have the ability to go down and go to the next vendor and go to the next vendor that does happen to specialize in those areas. Fine-tuning your fuzzy logic has been key for us in terms of really sort of implementing the proper tooling, meeting those regulatory requirements, but also understanding the client friction aspect of this. So if you are too strict adherence to your full match naming fuzzy logic and you require Lauren Benjamin equals Lauren Benjamin across the board, period, then you could be leading to a significant resourcing strain internally, and you'll be taking most of your clients to manual verification processes, which then can lead to significant backlogs, especially in crypto, where you find bull runs hit, fairly often, and then you find massive amounts of people onboarding, and you could be dealing with thousands of onboarding flows that kick to a manual verification, which lead to client friction because they have to be manually handled versus moving through what we call a happy path. If you're too liberal on the opposite side and you have, first and last name initials versus the full name and a zip code, for example, as your fuzzy logic, then you're not meeting your regulatory standards and you're not fully actually identifying and validating the information that's presented. I think that the key here, and you noted it really well with regards to both of these previous slides, is that you should think of KYB and KYC as a suite of tools. You're looking at identity and address verification. You're looking at documentary validation. You're looking at screening tools that address sanctions, PEP, negative news, adverse media, IP, geolocation screening. And then you also want to take into account client risk scoring, where you're going to be asking additional questions about the type of activity that they're conducting, the source of funds that they have, the industry or occupation that they're collecting, and being able to sort of aggregate all of this information to determine whether or not you're looking at a legitimate identity, a legitimate document, whether or not that person needs to be kicked to a manual review, high risk client onboarding, etc. So if you look at it from a more holistic package, I think you really do have the ability to know your customer outside of that sort of 50-year-old regulatory standard of onboarding. In terms of client feedback that we've seen, you hit it right on the nail. User friction is intense when it comes to manual onboarding. The greater the reliance on documentary validation, the lower the onboarding rates you're going to have, the greater the client friction you're going to see, and you're going to see clients drop off and just give up halfway through. On the flip side of that, the regulators and our banking partners and strategic partners expect you to rely on both non-doc and documentary validation, especially as a crypto MSB. So there's the balance of the regulatory and the user experience is really both the challenge and the goal.
Yeah, no, those are great points. And I want to circle back to one thing you just said about actually knowing the identity that you have there, because this is one of the big challenges we have these days when it comes to, I would guess for most of the business models of our audience, is all of your customer interactions are going to be virtual. The closest you might get to ever meeting them in person could be a Zoom meeting, if that, and that depends on your setup. The regulations, though, are still based around the assumption that verification can be, maybe should be, done physically. And this leads us to a very interesting question. If the customer is virtual, how can you state that you know them? And I'm not going to dump a whole bunch of philosophy textbooks on everyone, but it is a very interesting thing. My past interactions with regulators, I have been posed this question, how do you know the person uploading the image of the driver's license is actually that person? How do you know the person that the social security number you have is really tied to that person and is legitimately their social security number? Sort of piggybacking off that, Nalia, what challenges have you encountered with respect to understanding your customers if the relationship is purely virtual? How does this differ from physical verification, and what sort of advice would you give our audience when it comes to making that distinction?
Right. In my experience, so our customers are businesses, so less actual physical consumers. But from my experience facing and onboarding and the sort of holistic approach to the consumer, who do we call virtual customers, right? These are the people that only we're getting the KYC information through the online channels, right? So there's no face-to-face interaction. There's no really understanding and interpreting the body language or in any of that. So you're relying on the digital input in your system. So the main challenge is actually knowing if this is the real person, right? Is this the robot that inputting the fake ID? Is that the person somewhere in Botswana that is inputting the KYC information? Honestly, I would take this at a little bit of like a almost like a challenging approach, but to make sure that we are preventing the fraudster in the system, I think this is the becoming utmost challenge these days. Preventing fraudster from entering the platform, the system, is the highest priority. And so you almost have to like become the students of those people. You know, we're not, I think when we talk about fraudsters, a lot of people are thinking, well, they're just some people living in the shacks, you know, and they're just like doing this, you know, disjointly. No, these are sophisticated, technologically advanced group of people that their jobs are specifically to learn the system, to penetrate the system and take advantage of the system. So sometimes you're in a situation when you've got AI or a machine learnings that would be facing the same robots that on the other side of the system. So really, so what I'm trying to say is I think again, the challenge and the main goal really is staying relevant in a world where fraudsters are highly specialized and technologically equipped to defend the system. So I would suggest maybe spending more time to kind of like a maybe like Telegram. I'm sure Lauren is aware that the Telegram, you know, just to kind of like create the ID, like study how these guys can, you know, penetrate the system. So that's kind of from practical standpoint, my approach would be.
Say are like some of the key obstacles when this is a question for the entire panel, so feel free to jump in. What are some of the key like obstacles to virtually identifying an individual customer versus virtually identifying a business customer?
So with regards to specifically, again, I mean, it really depends on the business. I mean, if we're talking about identifying the business specifically to, you know, for example, the real estate, right? We also have applications that are completely digital. The entire application process is digital, right? But we also balancing it with the right to verify the information and go back to the customer and ask follow-up questions. That's one of the key. When it comes to the customer, it's the same thing. So making sure that you have a again great vendor that verifies the digital identity and have a right to go back to the customer and sort of have these follow-up questions of resubmitting information, for example. So balancing completely digital onboarding with possibly going back and asking real follow-up questions for the consumer.
I can add
Awesome. Yeah, Lauren, go ahead.
I think absolutely correct. When it comes to, I think there's a distinction between the KYC and the KYB process flows. It's a lot easier to validate an individual through the digital onboarding process than it is a business. Not only because of the documentary requirements that are associated to onboarding a business, at least within the cryptosphere, when you want to truly know the nature of the business, there's a lot more documentation that's required. It's not just that you're asking for the business formation documents. You need UBO information. If it's a high risk business, then you're going to be asking a lot more poignant questions and questionnaires and want to see policies and procedures. So in your regulatory environment and your banking partners are going to expect you to do the same for your business entity onboarding. So it becomes even more complicated. But I think the second point that she made is also totally valid. When it comes to business onboarding, again, the vendors that are out there in the world are a lot more, they face more challenges with regards to business onboardings. That documentation is not readily available on databases. It's often housed in some municipal office in some country and there isn't a vendor out there that has proprietary access to that data. And if there is a vendor that's willing to literally send a person on foot into that office, it becomes really financially prohibitive. So the ability to go back and forth and send out that RFI specifically on the business onboarding side becomes essential to being able to truly digitally know who your business, your institutional clients are. It's the same for your consumers, obviously, if you need to reach out, but I think the burden and the cumbersomeness of the business side is much more heavy.
Yeah, and I'd like to add to that, Lauren. I think you're right about the documentation not being available, but like a lot of these customers, the business customers, and I'm sure both of you have faced the same, is that they hold their documents close to them. So, they're not going to go register it somewhere, whether they're in the US, whether they're outside of the EU or elsewhere, the documentation that like talks about who they are as a customer is held closely. So sometimes it's even hard to get that documentation to be sent over to us, right? You'll get pushback if you're trying to at least, go back and be like, wait, but I don't understand. Can you explain more? Can you provide this document? There's a lot of pushback. And individuals too, like, to be honest, I feel like the old ways of actually going in, and opening an account is long gone. Most banks that we also know now have this online setup. And in my past experience, I've seen that it does, like when you have fraudsters, like Naila said, when you have these really well-experienced fraudsters, you can set up a ton of different vendors in a ton of different ways, but they will find a way to get through it. Like we've had places where, you have to take a photo and then hold up your ID and you see that there's someone holding up this person and their ID behind them because this, so they do come back with really innovative ways to get through you. But individual is much more easier than an entity, for sure.
No, those are all great points. I think that a sort of common thread that we brought up here is, especially now that our customer bases and our businesses are more and more moving towards online, this concept of risk really becomes much, much more important. And I would argue that, when it comes to risk and understanding your customers, a key part of that is trying to establish, and we'll dig into this a lot more, but establishing this risk-based approach. And that begins with understanding, okay, who should my customers be in the first place? Really developing and really targeting who is my business going to be attractive to, who do I want to be attracted to my business, as opposed to fraudsters, identity thieves, bad actors, and so on. And by starting here on your risk-based approach, you can then begin to start building your controls in such a way as to more easily distinguish between good actors and bad before you've even started your operations. Vaishali, given your experience and your position, for the members of our audience who are in the startup phase, who might not necessarily, have a lot of data to sift through, what sort of advice would you give them when it comes to assessing their customer base beforehand? What tips, tricks, and especially when it comes to trying to establish interactions and relationships with strategic partners, banks, and so on?
Yeah, so I think it's important to kind of, and you said it right, like when you think about risk, right, and who your customers want to be, you can think about the geography or the location of the customers, and you see that these are the kind of customers that you're going to have from this particular geography to this particular location. So when you're looking at risk, I would suggest that look, there are no easy way out, right? If you are a regulated institution or a fintech institution, whether you're a startup or not, you must know enough information about these customers that you're going to bring on. You must also have the rigor to kind of understand that if this is coming from a country that is more riskier than anything else, then you might need to do more due diligence and in-depth review. But at the end of the day, when it comes to presenting what your program and what your customers look like to your institutional partners, to your banking partners. It's about how comfortable you are presenting this program and how comfortable you are with your customers base, right? So it needs our regulations, the regulatory landscape can be quite gray. So at the end of the day, if you can present to a regulator or a banking partner saying, this is how I understand it, this is how I'm going to do this, this is my program and my process that I've set up for, more likely than not, they will accept it. They might come back and tell you, hey, it would be nice to do, A, B, and C, which is great. You take that in. But at the end of the day, you as a compliance individual, as owning a compliance program, need to be really, really comfortable with how you're going to assess the risk of your customers.
Yeah, that's a great point. The way that I personally think about it is like, let's say we're doing a basic risk ranking of our customers. We have our bucket with low risk, we have our bucket with medium, we have our bucket with high. High risk is what everyone cares about and looks at. And the way I look at it is, okay, is this acceptably high risk versus unacceptably high risk? And, a large part of this, I think, goes into, I welcome the panel's thoughts on this. It goes into this idea of, okay, we know our business model, we know our customers. If your business model is you're going to target high-risk customers, that tilts the scale quite a bit and forces you to rethink your control framework.
You're absolutely right. And you can't, and I was just going to say, you can have low, medium, high, very high, however you want to have your scale, but you can't have 70% of your customers sitting within high risk and very high risk, right? That's going to raise eyebrows for anyone that you're working with. And at the same time, you can't be in a business where that you are definitely, serving higher risk customers or serving higher risk products, have less than 5% in high risk, because that's going to raise eyebrows. So you're right, our control process needs to be built out in a way that it makes it adjusts to the kind of customers that you are going to have on your platform, and make sure that you've thought through the risk.
I just chime in, Shally, thank you. I always thought, and I always say to the industry that, you can have all the risk under the sky for as long as you can mitigate that risk. So there are businesses that have 90% of high risk environment customers. For as long as there are mitigation controls in place, we should be okay. I actually thought about, what about if we don't actually our customer is not the one that signs the agreements, for example? What if our terms and conditions stretches the definition of the customer to outside of who are we actually onboarding? That presents the question in multi-stage and multi-transaction environment, who is actually our customer? For example, in fintech environment, sometimes we're processing funds, but our customer risk is not necessarily the one that we need to pay attention. It's actually, the risk stretches out to the end payee or end payor, for example. Again, not with my recent companies, but back when I was in fintech space, this is the most frequent situation where you look at your customer base, but then you're so many degrees separated from the ultimate end users. Then it becomes the question, okay, do you really pay attention to the risk associated with the customer, the immediate customer that you get onboarded? Do you understand your risk associated with end-to-end transaction? So the risk, the entire risk control becomes very complex and nuanced. It's just kind of more like a provocative thought for audience and for a panel.
Especially from the crypto sphere, where you do find that on the post onboarding side of things, when you're looking at transaction monitoring and blockchain monitoring, the risk generally isn't coming from your customer, because you go through that onboarding process where you have all of these data points that you're able to collect. You've got a dynamic scoring process where you can vary that risk and adjust it as you see the transactional activity either matching or not matching the anticipated activity that you collected with an onboarding. but it's the exposure that the client has with regards to the transactional activity that does truly present the risk that we are reporting on, whether it be to OFAC or STAR filings or whatnot. You're right, it's that third party, it's the endpoint exposure that you're facing. I think the other point that I want to bring up is that when thinking about risk, it's not just the risk that the client presents, but how you configure those controls and those mitigating systems that you have in place to mitigate the risk. That can also create internal risk in an operational side of things, because if you are configuring it one way or the other, you're either missing factors, you're creating gaps, you're creating huge amounts of work. So you've got to think about resourcing and configuration
And I definitely want to put a pin in that thought because we're going to come back to it later. But what we've also discussed is, some of the unique risks that are posed to us from a purely virtual KYC standpoint. Issues involving fraudsters using synthetic identities, issues involving collusive counterparties, which I'm sure all of us have had a lot of experience with in the past. The vast dark market in stolen identities, social security numbers, credit card numbers. It feels to me like there isn't a week that goes by, but we get some news alert about a major financial institution that has millions of people as customers who has suffered a total data breach. And also the wide availability of software tools to, mount comprehensive assaults on your KYC controls to overwhelm them. And, from the fraudster standpoint, they don't care if they burn, 300-400 stolen identities if they can get 2 or 3 past you and then start jamming some sort of illicit activity through. Lauren, I'm going to start with you, but then I'd like the rest of the panel to jump in on this. What sort of specific difficulties would you identify as most critical when dealing with these specific sort of cybercrime and fraudulent activity? And how have these trends changed over the last, 10 years or so as the shift toward digitalization has just gained more and more momentum?
I think Nalia hit it on the nose earlier on when she's talking about the sort of sophistication and technological adeptness of fraudsters and these crime rings that are trying to onboard and conduct illicit activity on your platform. What's funny is I'm looking at this slide and I see synthetic identity, collusive counterparties, stolen identity through darknet markets, and I really see a sort of confluence of all these things coming together. And that's what I think you can really see within the bad actor sort of environment, is that it's never going to be just one of these things. It's going to be a combination of the above. So with regards to synthetic identity, we're an entirely digital platform. Escaping synthetic identity fraud is going to be nearly impossible to do, but we have to put in place all the controls that we can in order to deal with it. And the way we've done this is sort of doubling up and double downing on those controls. So not only are we requiring all of the required PII and the documentation to be submitted, we may require an additional document. I think Vishali, you noted the selfie document and having an individual submit like a life document. So we're going to say, okay, we want an ID that's required at onboarding. Certain red flags may be present on the back end. Therefore, we're going to ask you a selfie picture to be submitted. And then on our end, we're going to then take the PII that's submitted, the documentation for the identity document that's collected, and the selfie, and then do a series of comparisons between all of that to see, okay, does the images between the two documents match? Does the PII match the PII that's listed on the identity document? Have we any stored records of those images being utilized in previous onboardings? And then can we compare them to the types of activity in the PII that's collected? And when we do this, we do find, especially in the last few years, a rise in money mule rings that are onboarding to our platform, utilizing the same images over and over again with slightly different PII for both individual opening accounts, business accounts as UBOs, to facilitate illicit drug trafficking on the platform. And we can see the money coming in and coming out. I think in addition to dark net market for stolen identities, we're looking at the massive advance in computer generated imagery, from AI to just apps that you can download on your phone to create an identity document, to specific darknet markets that specialize in the sale of this particular types of documentation, to websites where you can go. I think our fraud team let me know. You can go to a website and buy an SSN that just generates it and passes through your very legitimate identity validation vendor tool that you have in place. So the complexity is that you're continuously having to learn to figure out where those typologies and trends are coming, what the fraudster, the new ring is doing, what the new fraudster train is looking, and consistently looking for patterns on our end so that we can then build more advanced controls to be able to fight it.
Yeah. One other threat that I would mention, this is specific to the KYB end of things, but just exploiting gaps in existing regulatory regimes. For instance, I can register a company in any state, and I can claim that George Washington is one of my ultimate beneficial owners. The Secretary of State's website is not going to check that. They're not going to do due diligence. They'll just accept the paperwork as filed. I pay my $75. I have an LLC. So, again, there's lots of potential vulnerabilities here. Nyla, Vishali, would love to get your thoughts too.
So just a quick thought. Absolutely. When it comes to, for example, the access to the platform, onboarding the business and giving access to, for example, in this case, to software and specifically to certain individuals. So what we've been encountering, it maybe not so much to a synthetic identity, but the type of fraud that the account takeover, for example. I think the good practice measure in order to mitigate that risk is definitely work closely with InfoSec and the cybersecurity team, internal team, to make sure you have a pulse on hand of what kind of preventive measures that we can have in place in order to not let that happen. It comes with 2FA, it comes to the verification of the email, but in ATO scenario, which we see more and more, email account takeover would be kind of wide spread. So 2FA, making sure that we have a phone number where we can call back and verify that that's still the same person, have other measures for us to verify whether that's the same person that initially was set up and we have a legitimate user in the system. The one remark to say, it's like, again, when it comes to fraudster, it's very hard to get rid of them when they're in the system. So try to do everything possible to prevent from happening.
Yeah, absolutely. I'm sure we have a lot of war stories we could share about that topic.
Yeah, I think for KYB, you're absolutely right. There are so many ways, John, that people can just even fake documents, fake IDs, fake, entire entities. I agree with you, Nyla. Once they're on board, it's difficult to get them off. But for some of these, it's the transactions actually and the review of what they're doing on your platform, which often then, lights up and be like, wait, this doesn't make sense. They said that they were a software, they're selling software and here they're doing hundreds and millions of transactions. That's, off. So that's when you start go back asking questions. But at the onset, I feel like if you do follow a thorough process of ensuring that you have gotten the right documents, you have asked the right questions, you've obtained the right information about this customer, it is a much more easier thing to defend when it comes to regulators saying that we did, and then we saw the transactions and then we shut them down, right? Or we did what we needed to do. So I feel like there is a combination of both of these to, for all of our companies to continue to maintain onboarding of customers.
Absolutely. So you talked a lot about the risk-based approach and how this drives the process for adopting and implementing a KYC framework that really works for you. So let's start to dig into that a little. Why do you want your KYC program to be risk-based? Well, fundamentally, if it's not risk-based, it doesn't work. The second thing is risk-based encompasses more than just what a regulator says you have to do, what a law states you have to do, what your bank or strategic partner told you what to do. It encompasses the compliance perspective and the business perspective, because fundamentally implementing KYC and KYB has a lot of business implications. There's the upfront costs of signing with a vendor, dedicating engineer time to implementation, conducting testing before you go live, all the training you have to do, which we'll get to. But, we've brought this up a little bit earlier in the conversation. There are the customer experience implications for this. So when we talk about risk basis, it involves much more than just compliance. It's a dialogue, between all aspects of the business, and certain aspects of the business fundamentally will not want this because it is a major amount of negative pressure on their own objectives. So, for those in the audience who are chief compliance officers and so on, you're probably familiar with the amount of dialogue that has to go into this, and bringing stakeholders to the table and getting everyone to agree to what makes the most sense for the business. Nyla, would love to get your thoughts on, from your standpoint as a VP, how do you drive that dialogue amongst the stakeholders in your business who might have wildly different opinions about trying to implement a given, KYC control?
Yeah, so again, my first thing is, look, we need a risk-based approach because we have limited resources, period. So we have to put resources where we have a higher risk areas in the business. If we wouldn't have unlimited resources, then be it, but this is just not the reality. From me as VP of Risk and Compliance, I think the key is keep open lines of communications with the business. It's always a communication feedback loop of what is going on within the business, being on the front ends of the product development and understanding what's coming our way, understanding what kind of products they're working on. So keep thinking in advance, what are the risks that could be associated with this business, with this product. Having a proper risk-based governance in place again, and this is where CCOs on the line would understand. So having a group of risk committee that would be involved in those ongoing communications with the business, understanding what's coming our way, what kind of type of customers the business wants to onboard and planning to onboard. Generally, and I don't think it's a secret to anybody, but the business would want to take every customer regardless of risk. So this is where we're stepping in and we're saying, all right, maybe there's certain types of the customers we will onboard tomorrow, but not now. And here's why. This is where, again, open lines of communications is crucial. Again, the same with just the one more to add is the same as having limited resources is we might just not pay so many resources to low risk customers, onboard them faster with a minimum requirements. We know those customers don't need to spend a lot of time. The same thing is with if there is a less commercially important customer, and I know it's a low risk, get them in. But if there is something that is on a higher risk, this is where we want to put more resources and attention.
Yeah, definitely. So when we think about this, from a practical standpoint, okay, we've understood our risk tolerance and we've talked that subject to death. Where does this lead us to? Well, the first thing I would argue is who's driving this risk tolerance. And this is a combination of your regulators, your bank strategic partners, and your investors and other internal business stakeholders. And to Nadia's point, getting them to come to a consensus is really important, and that involves a lot of communication and a lot of dialogue. Also, as part of this is before you sign with a KYC vendor or with a software vendor, we talked about this, like the impacts of implementing a KYC control or a new KYC framework, making sure that, again, you are staying in communication with those areas of the business that are going to be affected by this. So this is not just, your compliance analyst. This is your customer care team. This is operations, information security, privacy, if that's a separate function within your business. And a lot of it comes to them, or should come to them in terms of the framework where, hey, this is the risk we're facing. This is what we are doing to implement it. Here is how this affects you and your operations and your segment of the business. Let's have a discussion about this. Vaishali, I want to get your thoughts on something that we talked about a little bit earlier, but again, for potential, for businesses you encounter that are, in the startup phase, especially ones that are approaching, compliance for the first time, as it were. What sort of tips would you give them on how to conceptualize, this whole risk-based approach to begin with, and how to take that and then drive implementation, vendor selection, and so on?
Yeah, we definitely do see, and both even as customers, we would see these, entities that are just starting up. They're very enthusiastic about, establishing a really good, robust program. And oftentimes it's risk that drives all of it, right? It drives your program. And so you talk about the risk tolerance here, and some of the things that we discuss, or some of the advice that we've given to our customers is that, think about your risk appetite. Like, what is it that you are okay with? Which countries are you okay to do business in? Which as customers are you okay with? How much of a risk between you, business, policy, BD, and everyone else is everyone aligned and on the same plate? And then to understand what products and services we are offering that actually align and fall within this, business risk appetite that you're thinking of. And so a lot of times we've gone through programs or read through risk tolerances and appetites, and we'd be like, we don't always provide a ton of guidance for our customers, because we don't want to, at the end of the day, be the people to say that, oh, this is how you should write your program. But there are also tons of different vendors that actually provide a really good service for something like this, that help you think through how you should be thinking about your risk appetite, how you should be thinking about putting in a program that is more risk-based. And there are times that we've pointed them out to certain vendors and be like, look, we've worked with these guys in the past. These are good vendors. Maybe you should think about looking at those to help you analyze it. Because in a startup mode, oftentimes you're obviously short on resources. And you don't want to, your one person, two people, compliance team that you have, and trust me, I've been in those where I've been a one person compliance team. So you can't have that person think through this approach. You can have them talk to this vendor and work with them closely to make sure that they're aligning with what you need for your company. So those are always great options to have, and a lot of startup places that I've been at, they've done that. There are certain parts of your compliance processes that you can work with an outside vendor to get you to where you need to be.
Yeah, definitely agree. And pivoting the discussion a little bit, but part of this KYB process is going to be selecting vendors. Software is going to be a key driver for your KYC process, regardless pretty much of how you operate. If you make a risk-based decision that you wish to do your KYC using the good old Mark I human eyeball, I have no objection to that. It's a risk-based decision. But a lot of us are going to be confronted with the question of how do you build out not just one vendor, but probably a full tech stack of vendors. Biggest things I would say, are making sure that, okay, is this actually providing value, or is it just generating more work for me? There's no point, for instance, in trying to sign, 3 different top level sanctions providers and have them all running in parallel if they're all giving me the same results and my analysts are still spending hours and hours trying to process an alert for each of them. So when you're selecting your software vendors, make sure that you thought out ahead of time what tech stack should look like. Make sure that each one of them is actually, reducing the amount of time you spend manually. Lauren, you brought this up earlier, the amount of time you spend manually reviewing things. And, to a point we talked about a few slides ago, making sure that you communicate when you turn something on to the people that are going to be affected by it. And this is not just your compliance personnel. This is your operations, your customer care, all of your first line of defense positions. Lauren, I did actually want to ask you, you work with a pretty robust tech stack of vendors over at Kraken, lots of implementations. And, what are some learning experiences you'd share with the audience, both positive and negative, when it comes to vendor selection and vendor implementation?
This is a really good question. I think a really overlooked and integral part of your sort of control suite and library. When it comes to vendor selection, initially, I think it's twofold. You have to have a strong vendor management program in place so that you do involve all of the appropriate stakeholders before you even get to choose the vendor. So this would be including vendor selection, ensuring the appropriate teams are involved in the integration and looking at the RFP, the proposal that's being provided by the different vendors that you're going to be looking at. You want to ensure that you're looking at a comprehensive coverage for whatever particular tool you're looking for. Does it cover the jurisdictions that you're really needing to cover? Does it address the risks from your risk appetite that you are looking to truly address? What's the consistency of that vendor? Are they able to provide not just the verbiage that they can do these things, but can they do it? How consistently can they do that? Are they having blackout periods? Are they going to be meeting the quality and the standards of the data that you're going to need to be incorporating into your system so that you can conduct the review, so that you're not conducting an hour to 2 long screening review of an alert for multiple different vendors, but you have one vendor that is meeting the configuration that you need. Is it configurable? Do you have the ability to truly refine and enhance that tool once it is integrated? I think the implementation part is probably the most key, at least in my experience, with regards to how effectively and efficiently a vendor works within your platform. If it's not right, fine, but
Uh-oh.
regulatory in my face. So the implementation process is key, and again involves not the compliance people, because generally the compliance people aren't the engineers, but it involves a collaboration between your engineering department, your client engagement team that is the client facing first line of defense and knows how this works, the compliance team to be able to tell you what really needs to be in place. It includes the business to ensure that you're not becoming overly burdensome on the client user experience. So it really is a cross-functional collaboration to be able to choose a vendor. I think your last bullet point there, you have to train the business on what the tool is and how it works, why it's necessary from a regulatory and best practices standards, what the output is going to look like. You have to train your CE team to be able to look and see, okay, this is what that output is going to look like. This is what it means. This is how it affects me and my queue. Does this mean it's a straight through onboarding, or does it lead to a manual review, etc.? You then have to go back and test it and model validate and ensure that the configuration is accurate, make the adjustments when it's not. All of those things are truly key for choosing and selecting an appropriate vendor.
Yeah, those are excellent.
I would just add that when it comes to selection of vendors, specifically, for example, for something as simple as I wouldn't say it's simple, IDV solutions, for example, one of the first things I typically ask in our RFP process is the data. So what data are you relying on in order to verify the identity? And also, is it the first hand, or are you relying to some other partners? Because, for example, I know that some of the solutions, they have just simply integration with other partners. And so what's ended up happening is if in this line of integration, one of the partners have a blackout, that could affect the life cycle and onboarding process. And also just the final point when it comes to vendor, I typically ask also, how's UI, so basically user interface? Is it easy for my team of analysts to learn this process and be trained on, or it's very cumbersome and difficult? So
Yeah, also excellent points. Although I do have to move us along a little bit here because we're getting close to time. So I think the last sort of major area, we've touched on this a little bit throughout the webinar, but the question of how do you implement enhanced due diligence versus regular customer due diligence? And I think that, you know, the four of us, we could spend the next 5 hours probably talking about just this one slide. It's very, very in-depth. But I think the biggest thing I'd like to remind our audience is enhanced due diligence is about the most risk-based control you can set up. It has to be very tailored to your given customer and the given situation in which the need for enhanced due diligence arises, which can be either during onboarding or during your relationship with the customer. The things to remember is, you know, it has a purpose. You are looking at specific, very high risks that you need to gather specific information on in order to specifically mitigate. It's not a sort of check the box exercise where, oh, they wore red socks today, that means they get EDD, and I don't really care what the information is, but I did EDD, so we're fine. No, that's not how it works. So it's not something you can do outside the context of risk. In fact, it's a very heavily risk-based control, to the point where I would almost say, you know, it's a little bit separate from KYC and KYB, except it isn't, because it is integral to that whole process, but the approach to it is very different from sort of the blanket KYC, KYB that you apply to your customers in general. So I'll throw this out as a quick roundtable question to the panel. Lauren, start with you, and then Vishali, and then Naya. What are some of the common mistakes you've encountered with designing and implementing a useful risk-based EDD process? In just like 1 or 2 sentences.
I think from a risk-based approach, having too broad of a coverage for your high-risk client base leads to resourcing issues. And then ensuring that the actual output of your enhanced due diligence process is also tailored for the volumes that you're going to see. So you don't want to throw out too wide of a net and require too robust of a report, of a dossier. You don't need 30 pages on one particular client, because then you're going to end up with backlogs, and then you end up shooting yourself in the foot from a regulatory perspective, because you can't handle the actual input that you're getting.
Yep, I agree with what Lauren said. And to add to that, I think another thing is that the mistakes, or the issues are that you put out a list of the additional documentation that you want to get, but that doesn't really mitigate the risk that the customer is bringing on the platform. So you've gotten all this documentation, but at the end of the day, the risk, like, you still don't understand certain things. So I think to tailor it, like you said, like it's one thing to have an enhanced due diligence process, but to tailor it to make sure that it's actually, assessing the risk of the customer and basically being able to mitigate it.
I would say that if to add anything to so enhanced due diligence as any risk-based approach, it's not the static manner, it's not one and done deal. You gotta make sure that your customer base is changing, your business is progressing, you're updating your enhanced due diligence approach with the business. So when have you done the last EDD the refresh? It shouldn't be just like once in every 2 years. I think it should be more often than that.
Yeah, no, those are all excellent points. Thank you. And I think sort of to sum up our thoughts here is 2 things. Make sure that when you're implementing KYC, that you understand the consequences of what you're getting into and how this is going to affect not just your compliance department, but the rest of your organization. Going into the communication aspect, the training aspect, this affects your business on a fundamental level. So make sure that you're engaged with other members that this will affect. And the second thing, this has been brought up by our panelists a number of times in this discussion, is KYC is not your only control. You have transaction monitoring, you have ongoing oversight, screening, you have inputs and feedback from other business lines, other lines of defense. Those all have to factor into this. KYC is not something that to our point, you pour all these resources in, it's done, it's good to go, and you're perfect from a control standpoint. It's part of an overall framework. We are at time, so I would like to ask one question to the panel from the pre-submitted questions we got. For the audience, we will do our best to respond to the rest of the pre-submitted questions, as well as those that were submitted during the webinar, and send those out to you in a later email. But I wanted to pick up on the point we just brought up. Periodic review and refresh. Again, 1 to 2 sentences from each of the panel. Lauren, we'll start with you again. What is your thoughts on best practices for implementing a KYC refresh process?
That it should be based upon a sort of series of factors. We should look at the client risk score. We should look at the dynamic transactional activity that the client has had, that alter that risk score, the time of onboarding, and then be able to cadence it out appropriately. Not all clients need an annual review or a 6-month review. To Nadia's point, not always is an annual review appropriate if you're looking at a very high risk customer that has a dynamic process that is indicating more high risk flags coming in. So I don't think there is a check the box or a one and done approach for it. If you're looking at low risk, you can look at a 2 to 3 year or 5 year approach. Medium can be lesser, and then your high risk client can be even lesser than that. So it should be dynamic in what you're doing.
Yeah, I absolutely agree with Lauren, 100%. So one thing to add is that there are other controls measures that could indicate that possibly the low-risk customer all of a sudden becomes a very high-risk customer based on, for example, transaction activity. And so that customer would become a bucket of more frequently reviewed customers. So even though we're talking about periodic review as a set measure, sometimes it's just not the thing. Sometimes we move customers from one bucket to another bucket more frequently. And I think this is what Laura mentioned before. That's what constitutes a dynamic risk-based approach. So you're constantly looking at this type of the customers and constantly monitoring them and constantly moving them from one risk to another.
Well, I'd like to thank everybody. I'm sorry, we've went over in time, so I want to be respectful. We have a lot of people dropping off. But want to thank the panelists and thank John for moderating, and then also just one additional thank you to the MSBA for co-sponsoring and for the members who are able to attend. For the MSBA members, we will have the next meeting topic will be the NMLS renewal prep. So if you are an MSBA member, please join for the next meeting, which would be the second Tuesday of the month coming up in October. So we thank everyone for your time, and please feel free to submit any post-webinar questions, and we'll try to address those in a follow-up email. Thank you for your time.
Thank you.
Thank you all.
Thank you.